AS15 employee benefits. It's as good as completed only. It's a formality. We'll have a recap and then formally we'll put an end to that AS15 employee benefits. Employee benefits, AS15 covers all forms of employer-employee relationship, all forms of benefits given to employee except the share-based payments. Standard classify employee benefits into four: short-term, long-term, post-employment, termination. Short-term employment benefits accrue, fall due during employment. Long-term accrue, fall due during employment. Within 12 months short-term, more than 12 months long-term, from the end of the period in which service is rendered. Termination benefits accruing on termination. Post-employment benefit accruing during employment. Both falls due after employment. Understood? Both falls due after employment. Termination accruing on termination. Termination benefits accruing on termination. Post-employment accruing during employment. Definition over accounting. Short-term employee benefits should be accounted as expenses in the year in which service is rendered. Due not paid liability, advance payment is assets. Short-term compensated absences, non-accumulating, no special accounting. Accumulating time, vesting, non-vesting. The value of the short-term compensated absences shall be identified and shall be measured and recognized as expense and liability in the period in which service is rendered. In the subsequent period, where the leave is availed, where the service is not rendered, where the employee avails benefit, it shall be reversed. If payment made, then it is liability to cash. If payment not made, then the liability will be reversed to P&L. Long term will be the same as post-employment. Termination is accounted as expense in the period in which termination occurred. Due not paid is liability. The amount of liability payable more than 12 months then will be recognized at the discounted value. Post-employment benefit should be recognized in each year. Expense and liability for defined benefit plan. Defined contribution plan, the amount of contribution is expense. So in the defined benefit plan, the various components of expenses are current service cost, interest cost, expected return from plan assets, actuarial gain or loss, past service cost, effect of curtailment and settlement. That is gain or loss from curtailment and settlement. Current service cost procedure. The entire process is called projected unit credit method. So estimate the last drawn salary. Based on that, identify the total benefits. The total benefits payable after employment divided by number of years of service, it will give you service cost discounted to present current service cost. Interest will be charged on the opening liability every year. Whatever interest rate applicable for that year, in last year some other rate, current year different rate, whatever rate apply on the opening liability will be getting interest cost. Expected return from plan asset. Plan asset, contribution or investment made against the liability is plan asset. Income from such investment is called expected return from plan asset. Not the actual interest or dividend including capital appreciation, and thereby it is measured by the actuaries. It is measured by the actuaries. Expected return on plan asset is nothing but plan asset into expected rate of return. But finally you will arrive at the actual return from plan asset. Actual return from plan asset will be computed this way, comparing opening and closing fair value. But after nullifying the effect of additional contribution or amount withdrawn during the year. So I repeat, it is closing fair value plus amount already withdrawn minus additional contribution minus opening value. Otherwise from opening also you can compare and find out actual return. The difference between actual return and expected return is actuarial gain or loss. Similarly, actuarial gain or loss will also arise because of restatement of liability at the end of the current year. It is because of change in the estimated growth rate, or it could be because of the discount rate that you are using. Because of that you will get actuarial gain or loss. Past service cost. Whenever there is modification to the plan and the benefit is increases, then the total benefit is increasing, so thereby service cost per annum also will increase. So service cost from the current year based on the new terms, service cost of the past should be restated, and that is what we call it as past service cost. Such past service cost shall be amortized immediately if the plan is already vested. If it is not vested, it shall be amortized over the remaining vesting period. For each and every provision we did problems. Effect of curtailment and settlement. I told you effect of curtailment and settlement. In a general discussion we have made, formally we will complete that. curtailment, shrinking, reduction in liability arises because of either reduction in number of employees or maybe reduction in benefits. Generally it doesn't happen so, but sometimes the reduction in benefit may be possible. So thereby curtailment refers to the reduction in liability, the reduction in planned liability arising from reduction in number of employees. We create liability if not for one employee, we may create for say 5,000 employees, 500 employees, depending upon how many employees are there. So the total liability, there will be gratuity liability. So the total liability is reduces. That is what curtailed, reduced. It is arising because of reduction in numbers or a benefit being reduced. Suddenly we find that it is not 40% of last earned salary, we are telling that it is only 36% of last earned salary. If the benefit increases, then past service cost will increase, correct? If benefit reduces, current liability is reduced. So thereby when current liability is reduced, then it is considered as curtailment. Either reduction in number of, out of 5,000 employees, say 200 employees are leaving the organization with a settlement. So thereby it is called reduction in, curtailment, or maybe reduction in benefits. Understood? A curtailment primarily refers to reduction in the liability arising from reduction in numbers or maybe reduction in benefits. Settlement. So what is that settlement? Ad hoc amount is settled. Ad hoc amount is settled against the liability of against the defined benefit plan liability. An ad hoc consideration is settled against a defined benefit plan liability is called a settlement. So which means you have a liability, now you are settling against that liability, an ad hoc amount is what we call it as settlement. So you have curtailment without settlement or curtailment with settlement. Shall we proceed? Reduction in liability without settlement, reduction in liability with settlement. So we find that curtailment without settlement curtailment with settlement. Curtailment without settlement, curtailment without settlement will be considered curtailment without settlement. In that case, proportionate reduction in liability shall be expensed in the year of curtailment. Proportionate reduction in liability shall be expensed in the year of curtailment. Suppose we have created liability for 100 employees. We have created liability for 100 employees and our liability is say 5 lakhs. We have so far created liability for 100 employees and our liability is 5 lakhs. And this is only 2 years have been completed from the commencement. So for 2 years we have created a liability of for 100 employees. Shall we? Okay. Now suddenly we find that at the end of second year or maybe at the beginning of third year, 10 employees are leaving the organization. 10 employees are leaving the organization before the plan is vested. So which means for them there is no dash benefits. Retirement benefits. Could you appreciate? So thereby, but we created the liability for how many employees? Because we don't create the liability after vesting. We create the liability right from the first day of service. Understood? So thereby, the plan was, liability was created for 100 employees and for up to 2 years the liability created so far 5 lakhs. Understood? And 10 employees are leaving the organization before the plan is. So whatever liability relation to the 10 employees will be expense. That's the point we are conveying. Could you appreciate that? Loss on, it is gain on curtailment. This is the gain on curtailment, and that will be transferred to P&L. Understood? So under P&L again, this will not be shown in a separate head. It will be shown under the defined benefit plan expense, where you will aggregate various items. What are the various items? Current service cost of that period, interest, expected return, actuarial gain or loss, past service cost. Under that, one more item is getting added there. Understood? So this gain, which will be a deduction. Loss means added, and the gain means it is a deduction. That's all. Clear? Everybody? So this is what we understand. Curtailment without settlement. No settlement is made. Just the liability reduces. Whatever amount of liability reduced will transfer to what? P&L. Understood? It will be expensed. Shall we proceed? Okay. Curtailment with settlement. In that case, the difference between the proportionate reduction in liability, and the amount of settlement, is adjusted against the defined benefit plan expense. The difference between the proportionate reduction in liability and the amount of settlement, within bracket gain or loss, is adjusted against the defined benefit plan expense. For example, we have 100 employees. We have created a liability for 5 lakhs. The liability amount is 5 lakhs. Imagine it is only 2 years. Imagine it is still only 2 years. Even though the plan is not vested. But the 10 employees are leaving because of your curtailment in operations. The 10 employees are leaving because of curtailment in operations. And you have guaranteed them the job for so many years, and suddenly they are losing the job. Correct? It is not voluntarily they are going out. It is that business is not in a position to accommodate them. Could you appreciate that? In that case, they will go for a strike and so many other things will happen, and we will make an amicable settlement towards that retirement benefit also. Understood? Because we already created the liability. So for 100 employees, we created 5 lakhs. For 10 employees, how much? 10 employees, how much? 100 employees, 5 lakhs. For 10 employees. But not necessary that we would have settled 50,000. We may have paid more than, or we may be paying less than. Based on the negotiation that is arrived, an ad hoc amount will be settled, and that amount may be more than the proportionate liability or less than the proportionate liability. If it is more, then it is loss. If it is less, it is gain. Will be adjusted against the expenses. That's all. Understood? Which means liability will be reduced by 50,000. Whether settlement is there or not, liability will be reduced by. So with settlement or without settlement, liability is reduced by 50,000. Entire reduction may go to P&L, or only the difference in settlement will go to P&L depending upon settlement is there or not. Understood? Suppose it has been given that we are paying 60,000, which means 10,000 will be adjusted in the P&L. So it is like liability 50,000, expense 10,000, to bank 60,000. Understood? Suppose no settlement took place. Yeah, liability to P&L. Are you following? The liability will be entirely adjusted against the P&L. So that, and in P&L it won't appear on the credit side, it will be adjusted against the expense. Could you appreciate that? Everybody? So this is how we have. So if there is curtailment with your settlement, means an ad hoc amount is settled. Curtailment arises because of, it is nothing but reduction in liability. The reduction in liability may not match with the amount of settlement. Are you following this? Everybody, if the plan is vested, at least normally settlement will be equal to the value of liability. When the plan is not vested, an negotiation will be made and an amicable settlement will be made, generally an ad hoc amount, which may be more or maybe less also. It depends upon the negotiation power. Understood? And ultimately it can result into some gain or loss, which will also be adjusted against the expenses. This is how we have various components of the defined benefit plan. The only area where you have maximum discussion in AS 15 is the defined benefit plan. In the balance sheet, defined benefit plan will be shown on a gross amount. True, respond, don't sleep, please respond. If I tell some blunder, now you should immediately oppose it. You also listening. Yes, sir, correct. Defined benefit plan will be shown as a net of what? It will be netted off against the plan asset. If the plan asset is more, it will be shown in the asset side, and if the plan asset is less, it will be shown in the liability side. Understood? Everybody? So these are all the various discussions in relation to AS 15. Understood? Everybody? And we are putting a formal end to this AS 15, but it is not end of your education. You can study, you can refer the last examination questions and revise. If time permitting, towards the end we will like to discuss various examination questions from accounting standards. Understood? Most of the things are covered. Maybe latest one or two added we will be discussing towards the end. Shall we?